Really what you're focusing on is the level of rental income that's coming into this property suitable for me and my needs over the long term.
Welcome to Financial Foundations with Thomond Asset Management. I'm Neal Kelly, founder and director of Thomond Asset Management. Today I'm joined by fellow founder and director David O'Neill and Stephen Garavan of the Independent Trustee Company. Welcome to you both. Today, I suppose we're going to talk about the unusual fascination that Irish people have with property. And I suppose it might be fair to say that we as a nation are somewhat obsessed by property as something we feel we understand, or we feel that it is the be all and end all. So although today's discussion is not to promote property in any shape or form, it is really just discuss property investments using your pension, which in itself is pretty straightforward, but there are some nuances to it, unlike buying it directly or investing in it directly, that make it somewhat more challenging, and a lot of issues people need to be aware of. Okay, and I suppose, Stephen, given your responsibilities, given what ITC do, your insight into this will be, obviously very valuable. But I suppose to you, Dave, in your day-to-day dealings with clients, how common is it that somebody asks you about property investing?
Well, I suppose it's actually quite common in the last 5 or 6 years. I'd say there was a huge uptake in those inquiries maybe from 2017 onwards. It's very common now. So probably 1 in 5 people would, when you're in pensions, even if they don't have sufficient funding in pensions, they're querying the possibility of buying a property in the future. And we do probably get an inquiry maybe at least on a monthly basis on people asking, what's the process like? What does it go into? How does it work? What's the efficiencies of it? So it's quite common, believe it or not.
I suppose we'll come to it in a little bit. Picking a property from an auctioneer's window is one way to doing it, but there are, I suppose, other ways of gaining access to the benefits of investing in property. I suppose, Stephen, we all know that pensions can be a complex structure, confusing, complicated, lots of rules at the best of times. But I suppose, investing in property with your pension, residential and commercial, there are potentially a lot of restrictions to that. There's probably rules that people don't quite understand. Could you go through some of them, just so people kind of understand, there are limitations. It's not a free-for-all.
Absolutely, yes. And thanks again for inviting me along here today. In relation to the rules and the regulations that are laid down, they're typically around the revenue rules. So they're quite stringent in what's laid down. So you have the sole purpose. It's for the purpose of providing retirement benefits. Secondly, it's the arm's length rule. And this is a rule that really a lot of people fall foul of, is that you can't put anybody belonging to you, a family member, a business partner, into the property, or they can have anything to do with it. Nor can you have anything to do with it, because you need to have a property manager put in. And that is a revenue requirement, that you have a regulated property manager put in to manage it on your behalf. And that's something that is very strictly enforced. Also, you have the whole area around liquidity to make sure that there's enough fees within the scheme to discharge the scheme fees
to run
the whole thing.
Yeah,
exactly.
Yeah.
So it's quite an area that over the years that a number of people fallen foul of, and particularly the arm's length piece. And I can't emphasize this enough, that really has to be taken into cognizance when anybody is looking at the whole idea of it, because if you fall foul of that, the penalties are quite severe.
The arm's length rule, from my own experience, is usually a big one. Somebody buys a property, and they think they're going to be, I'm being smart now, picking the curtains and, pulling in the furniture and all this kind of stuff. They really don't get to do that. They benefit from the investment, not the ownership of the property. And that people kind of are a little bit lost, or they're a little bit confused about what that means. In terms of pensions are quite complicated. There's lots of different options. In terms of structures, what would typically be the type of pension structure that people will use?
Typically, the type of structure that they would use would be in the self-administered space, typically where you can set up your own single scheme and basically make a contribution or transfer benefits from other pensions that you may have elsewhere and bring it in, and then you can, through your financial advisor, and it's very important that you take financial advice on this from your financial advisor, from Thomond Asset Management, and also from the estate agent, to make sure that you're making the correct decision for you. Because ultimately what you're looking to do is provide long-term retirement benefits. And really what you're focusing on is the level of rental income that's coming into this property suitable for me and my needs over the long term? And that's key, that's paramount.
Yeah.
And
okay. I mean, like, Dave, in terms of the structure, we'll assume the client is the right type of structure. A lot of people get lost in this idea because they feel that they understand, or they think they understand that investing in property is going to an auctioneer and buying a property. But there are other ways to gain access to investing in property that isn't bricks and mortar and arm's length rules and challenges there. I mean, what are the other routes?
Definitely. Well, I suppose, look, with Stephen, I suppose he's dead right. The biggest thing that people come across first is the fact that they don't get the concept that they don't own the property. That it's the pension fund that owns the property. If you can get your head around that, the arm's length rules are a lot easier to understand, and the effect how you get a smoother transition with the client. But other than that, then going down the self-administered road to buy the property that you decide is the right one for you for an investment strategy, you can enter the market through the life insurance products that comes with its own risk, which is still technically a bricks and mortar property investment. But it would be part of a property fund with a life insurance structure like Aviva or Zurich, or they all predominantly have them now. You can have UK, Irish, so on and so forth, depending on what market you're into. The other side of it, there is REITs, but they don't really carry the same diversification, in my view, as bricks and mortar property fund would have, as in REITs do tend to sometimes fluctuate in the same way as stocks and shares and equities.
They can be traded on the stock exchange.
Yeah, they can. And people think that they're in a property fund and property goes up in value, but the REITs falls and they don't understand why, so on and so forth. But predominantly, I suppose, it all depends on the type of fund the person has, whether property is something that they are really interested in. But really, they seem to not really view property as a high-risk asset, which is probably fundamentally the wrong thing to do.
I suppose that leads to the next, next thing, Dave. Why would a client actually invest in a specific property? They go down the high street, they see a property in a window, and they say, gee, I could make a nice return on that. What typically is their motivation? Why are they doing it?
Okay, I suppose.
Or why do they think they
realistically, property is, just for the purposes of clarification, is not low risk. It's when you go down the road of the self-administered property fund. Okay, well, what's attractive on a self-administered property fund is it's a bricks and mortar bespoke property that you've picked out. You adhere to all the terms and conditions through ITC, through Stephen, and so on and so forth. And once you've all that, the tax efficiencies on it are quite good. So you can hold the property through thick and thin, and it'll appreciate in value like every asset class over a prolonged period of time. So if you're in your 40s, mid-40s or 50s, and you've got 15 or 20 years to retirement, chances of capital appreciation are very high. On top of that, then the rental income, which seems to be the big driver behind an awful lot of decisions, it goes into the pension tax-free.
Which is a big
benefit.
It's huge. What people don't realise when they buy property outside of a pension is that the rental income is taxable at your income tax rate, whatever that is. Be it 20% or be it the 40% rate. You're losing nearly half of it.
Absolutely.
And people tend to they don't understand that.
It is a big thing, the rental incomes, and I know rental incomes at the moment are at all-time highs and they're super attractive and so on and so forth, and that could itself drop a little bit in the future. But revenue do have a very strict rule, and it's a very simple rule to follow. When you buy a property with your pension, it has to be deemed an investment. To be deemed an investment, it has to be rented. You can't buy a property for capital appreciation. So the rental income is, to me, key from start to finish on why people would buy a property with their pension. The tax efficiencies of rental income, the gross roll-up of the rental income, the lack of capital gains tax on the growth within the pension structure itself, all those tax efficiencies rolled into one can, for a not so high risk investor, come across as a really solid level-headed,
long-term.
and they can get their head around it. They
Yeah.
understand it better.
Yeah. So, I mean, I come back to a point you made, Stephen, it is for the purposes of providing for your retirement. And I've seen this is that, back, we'll go all the way back to the financial crisis where people were buying properties and flipping them, quite quickly. That in itself is not allowed within a pension. You can't just buy it and turn it over.
Correct, because trading, you're not allowed to trade within a pension, so trading income comes in under different tax regulation. So exactly that, but it's an important point that David makes. It's to come back to why pension investors get into property in the first instance.
Yeah.
It's for the provision of long-term retirement benefits. It's a long-term savings plan. So by getting into property where you're locking into a long-term rental scenario where you can deliver those benefits over the long term.
Yeah.
Now, if you go back to, and this is the only thing that I can talk about given the recent experience, i.e. the recent past, going back to 2008 to 10, and when you had the property crash, that typically you'll find that when that happened, anybody that was invested in property, of course the properties went down, but particularly on residential property, there was the social aspect to it. People always need roofs over their houses, or over their head, excuse me. And then with regard to, if something happened to the property, if it went on fire in the morning, well, you had fire insurance, so you could rebuild it again. Whereas people in Anglo shares or bank shares, and they were gone in the morning. So fundamentally, the property will always retain some kind of value, particularly from that aspect. And typically, and again, I can only point to our recent experience, and I'm not saying predicting the future at all, is that when you look at the properties that did fall away, it was because of gearing.
Yeah.
And that's really what hold them below water.
Yeah, this comes back to my next point, gearing, otherwise known as borrowing. I mean, most people understand it, but it's known by another name in terms of it's a mortgage. But, you can borrow money within your pension to purchase a property, And again, though, there are limitations around that as well.
Yes.
Would you like to kind of elaborate on what some of those limitations would be?
Well, the first limitation is on the advice phase. And it's so important that individuals get the advice from their financial advisor, from Thomond Asset Management, and from their estate agent to make sure they're buying the right type of property for their circumstance. And if that includes gearing, that's absolutely fine. It suits a certain risk appetite, it suits a certain risk profile. And there are a number of lenders out there in the market that facilitate that, both on the residential side and on the commercial side. And they're very good and they're very well managed and their processes are very good. But again, coming back to the key point, it's for a certain type of investor that wants to do that. Because you are substantially increasing the risk by taking on gearing.
Yeah.
Now you can increase the return, because when you come back to one of the original points both David and I have made, it's about the rental income coming in. If you have rental income coming in and it's not covering the cost of the loan, well then
it's a bad investment.
It's a bad investment. It's not really going to work out. Now you have to, that's where the financial advice piece really comes in, when you just look at not just the pension but the entire view of the client's portfolio and to see whether it makes sense or not. But yes, there are a number of providers out there in the lending side, and yes, you can. It's just like getting a mortgage for your home. You can take out a mortgage for your pension to purchase property within it. But again, it's for the provision of long-term benefits. And going back to another point, and sorry to repeat, but it's all about, it's there for the long term. It's not there for flipping. It's not there for buying and selling then very shortly. Now, of course, the commercial reality is that the value of property goes up and can go up. And of course, you can sell it. But then if this becomes repeated, then revenue would probably have an issue with it.
They'd probably flag it, yeah. I mean, David, I know asking the question, but, our experience is that there have been some, shall we say, disasters for some clients in terms of the investments that they've made.
Yes.
I'm aware of one in particular. Thankfully, you're the one dealing with it. But I mean, foreign property. The wrong properties were invested in and fallen foul of a lot of those things.
Yeah.
In your experience, what have been some of the disasters?
I suppose we still live with some of the legacies. Thank God that we have a far slicker system now. Regulation is actually much better. It's it's very straightforward. You know what you can and you can't do. I don't like grey. Like, black and white is very simple. You can't do this, you can't do that. But there is some legacy stuff there. People, I suppose, if it's too good to be true, then it's too good to be true. And with a lot of the old stuff that was there years ago, the rules around it, there's a reason that the rules are so stringent today. The reason that revenue will look at this stuff, as Stephen has said, if a guy goes in there, buys a property for 3 or 4 years, has it rented, and adheres to all the rules, and then he gets a crazy offer on it, which commercially makes sense and makes sense for the pension, yes. But if you see that happening twice, and nobody is that lucky, revenue will highlight that side of things. So from that point of view, it's not as bad now as it was then. I do have 1 or 2 legacy cases that I inherited, but I suppose from the point of view of the pension itself, it has to all make sense. The property has to make sense. The rental yield has to make sense. You have to weigh it towards, would you get a better return in equities? You've got to risk profile the client to make sure that the client is suitable to this. But predominantly, what it really comes down to for some investors is they actually understand property. It's an Irish thing. We love to own. That's the part they struggle with. You don't own it. Yeah. But they understand property, they understand rental income, and they understand how it all works. Where stocks and shares and equities, I feel that in Ireland we're a little bit behind on our clients' knowledge of that. And there's a huge fear of stock markets, and you hear about the collapses. I mean, in the last 20 years, we probably have had 4 or 5 corrections in the stock market. We've had 1 correction in the property market.
Fair point.
And that's, I suppose, why people mistakenly think that property is low risk.
I'm going to finish on this particular point, though, Stephen, is that, we invest in a property and a pension, but the investor has, for instance, not met with the requirements of the revenue. They've breached some of the guidelines and the rules. Historically, what has been the revenue's attitude towards that? If a client is blatantly in breach of any of these guidelines, what's the outcome here?
Well, the outcome is quite catastrophic for the investor, for the pension holder, because if revenue become aware of a breach, particularly the arm's length breach, and that's typically where it happens, is that you have to repay all of the reliefs, and it can also include interest and penalties.
Wow.
So from a pensioner trustee perspective, what you'd be doing is if you find something or somebody comes to you and they have said that there's an issue here, you do everything you can to rectify it, sell the property and sort that out. Or if it goes beyond that then and the revenue become involved, as I said, they are the sanctions that can be taken.
Interesting. All right, guys, thanks very much. If anyone has any issues or queries in relation to their pensions and investing in property, please feel free to contact Thomond Asset Management. Contact details will be down below. Thank you for joining us.